Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review one of the most simplest examples of velocity banking. And again, if you have no idea what velocity banking is, go ahead and click the link down below, Velocity Banking 101, and then come back to this video to continue your studies. So usually when I do velocity banking, I have like 5 or 6 debts, right? Or 3 to 5 debts, or sometimes as many as 15 debts. But here, we're just going to have one debt, which is a credit card. And before I actually get into the spreadsheets like I normally do, I wanted to highlight this credit card because one of the things I always talk about is like, oh, you can't pay rent with a credit card, or there's always like an extra charge or fee that's insane that'll probably prevent you wanting to do it. But here, in this webpage, there's actually a credit card called Built that I actually found out from another finance YouTuber named John Liang. Again, we're not sponsored by them. I don't even have this card, to be honest. But I thought it was cool that there's a card specifically built around getting points and rewards for rent payments without the transaction fee, and you get up to 100,000 points each calendar year. Right, so 100,000 points sounds impressive, but that's about $1,000 a year, which is not bad. But again, so in other videos we talk about, oh, paying rent, you might have to pay in cash, but let's assume that you got this card, right? So now you can do velocity banking in its entirety if you're a renter, and you can just use it with this credit card if your credit card's your only tool. All right, so now let's go to the topic. So here we have our velocity banking spreadsheet, right? And so one of the things that we have to figure out is what are the two requirements that we always need for velocity banking, and I always repeat this in every single video. So number one is a budget. And that's what we have here. I've kind of prefabricated a budget, right? And so we have paycheck, expenses, checking, savings, left over, expense breakdown. So after you figure out your expenses, or you may just do your expense breakdown first and then just do a sum total of everything. We're just going to assume that we only have one credit card, $12,000, one credit card, okay? And maybe this Christmas you went YOLO because you've been very conservative with your finances, and that for whatever reason you just thought, you know what, I only live once. I'm going to be so generous, give insane Christmas presents to everybody I know. And if you're like that, come email us on our YouTube channel, and I got some things that I want you to buy me. um, yeah, so maybe you want to travel, you spent 12 grand in 1 month. I can't even spend 12 grand in 1 month. Or maybe I can. I don't know. I don't think I can though. But you did it for Christmas and you went all out, and you're like, all right, I've never been in this situation before, right? So that's the first thing. Now, the second thing we need is our operating account, which is our line of credit. So what's the line of credit? All it is a tool where you can borrow money, pay it back, and then use it over and over again. Isn't that what a credit card is? Now, credit cards usually have some restrictions. So, for example, sometimes it's very hard to pay rent with the credit card and other loans and all that stuff, but we don't have any other loans here, so we're not going to talk about that here. But there's other lines of credit like personal home equity. I got over $220,000 in lines of credit. So this scenario definitely would apply to me, but it might apply to you, right? So but this is going to be our main operating account, this 12K credit card that has a balance of 12K, right? Rather than our checking and savings. And here's what I don't want for you, right? So let's say you have a $12,000 balance and you actually have $12,000 in your checking and savings, right? That's where the bank kind of wants you to be. They don't want you to pay off your debt quickly, right? Because if you pay off your debt quickly, you're not going to make money. And here's the thing. If you ever want to understand a bank or a lender, think of it from their point of view, right? If you ever lent somebody money and you're planning to make money with interest and they paid you back like 1 or 2 months later, wouldn't you be pissed because you're not making any money, right? I know I would be. And that's why I'm saying the banks kind of want you here. They want you to have this nice checking and savings cushion while still having debt at the same time. Okay? What we're going to do is use our entire paycheck, put it into our debt, and then use our credit card line of credit as our main operating account. That's really the only difference. And I gotta write this down. I think I wrote this down somewhere. Yeah. So let me go ahead and move this up and copy and paste it. So what are the two requirements for velocity banking? Budget. We almost have that. Let's go ahead and complete this. So we have our credit card. And one of the ways that we can calculate minimum monthly payment, we can use bankrate.com, one of my favorite websites. So let's go ahead and put 12 grand here. And then I'm going to go ahead and put 30% here. And there's various ways that the credit card minimum payment's calculated, but I always just refer to this default payment calculation, although you should ask your bank because every bank is different, right? So now we're going to go ahead and put in that 420 as our minimum payment, right? And what's our rent? I don't know. Depends on you. I remember last time I rented, which was like in 2020, my rent was about 1,200 a month in a luxury apartment, but I was just living one person, one bed, one bath, and I kind of enjoyed it, but it kind of, I really sometimes I didn't like it living in an apartment, which is why I eventually bought a house. But here, you can kind of look up rent averages. So Hawaii has the most expensive rent, and then after that in California, apparently. Interesting, right? So maybe Hawaii's a nice place to visit, just not a place to live, right? And so Hawaii, California, and then let's take a look at the cheaper states. So hopefully you live in one of these states. North Dakota, never been there, but probably is a nice, beautiful, scenic area. Oh, it says don't mind snow or gray skies. Ew, gross. I don't want to. I like snow, but I don't like gray skies. Right? But you may want to live one of these places, which is pretty sweet, right? But again, the average of your rent or the rent that you're paying is going to depend on your specific area, right? Whatever you might be on this list, but I'm just going to assume it's 1,200. Okay, so let's just assume it's 1,200 in rent, and instead of paying in cash, we now have a credit card that we can pay with and get 1 point per every dollar we spend on rent, and we can make up to 1,200 points a month, which I think is about. So what's 200 points? That's $2. So 1,200 would be like $12. $12 a month, not bad. I mean, it's better than nothing, right? All right. So now food, gas, insurance. I'll say 1,200, right? In fact, I don't know if this is low or this is high, but I remember meeting someone who was like six-figure paycheck to paycheck, and his general expenses without debt was about 2,500 a month. So take that for what you will, right? But we'll say 1,200. Okay, so now what we got to do is sum up our expenses. So we just do equal sum B8 colon B10 because we're saying let's sum up everything from this part right here. Okay, so now that's 2,820, right? And then what's left over in our checking and savings, it's this minus this, right? So that's B2 equals B2 minus B3. And now we have $1,180 in our checking and savings, which is not bad. Like if I had that much in my checking and savings and no debt, I guess that would be okay. But we have debt. So we got to get rid of the debt, increase our cash flow. Now, here's the thing: if I were making 10 grand a month and I only had $1,000 of savings and I had all this debt, I'd be sweating a little bit. But a little bit different situation here. We only have one debt. All right, so now we're going to do velocity banking. So what's our main operating account? It's going to be this credit card. We're just going to assume that it has a $15,000 limit and it's a 12K balance. So now let's go ahead and put in $12,000 balance. Okay. And we'll say this is month 0. We're doing velocity banking. Again, same income, same general expenses, but here's the cool thing. When we make the credit card as the main velocity banking account, this goes to 0. Because what's going to happen is we're going to dump our entire paycheck into the line of credit, which is going to satisfy the minimum monthly payment and minimize the interest because we're going to have the lowest average daily balance of that point when we dump our entire paycheck into that line of credit. Okay, and then we take out our expenses accordingly, right? So our expenses is actually just going to be these two right here, right? So equals sum of C8 to C10, right? And then it's going to be our checking and savings is going to be 0 because what we're going to do is put our entire paycheck into here, right? And take our expenses there, and we should not have any checking and savings into unless there's something we actually absolutely need to pay in cash month to month. I don't want to have anything in checking and savings, right? And what's our cash flow, right? So what's our cash flow is just this minus this, right? So it's equals C2 minus C3. And that's $1,600 a month, okay? So $1,600 a month. So what we expect is that after every month, it's going to go about $1,600, except for the interest, right? Now, we might accrue some money, $12 a month, and hopefully, when we pay for other expenses, travel, dining. I'm not much of a diner, but you get 1 points in other purchases, so you'll probably make more than. Let me just see here. If we're spending about 2,400 a month on our general expenses, we're probably going to at least make about an extra $24 a month, just based on our rewards, right? Now, I don't know if that makes a significant difference. Let's see. We'll just assume that we don't get that amount, but that's a big benefit to you just by doing everything in the credit card, right? All right, so now month zero, so balance $12,000. Month one, so what we again put our entire paycheck into the line of credit. Now it's going to be 8,000, right? And then we take out our expenses from the line of credit, so that's an extra 2,400. So I'm going to just do this: 8,000 plus 2,400. That's 10,400, right? So it's the same thing as minus 1,600, okay? And then now what we have to do is calculate the interest. So let me go ahead and do that. And then, no, we don't want the sum of it. What we want is the average daily balance. So average between this and this, right, is 11,200. So that's not the average daily balance, but it's just the midpoint between those two numbers. But that's a good starting point for the average daily balance, because you don't know what the average daily balance is until you swipe your card for your expenses, and who knows when that will be. And then what we're going to do is type in the interest rate. So that's 0.3, 30%. Now here's the last thing. You got to divide by 12, right? Because interest rates quoted annually, but monthly interest is you divide by 12, and that's an estimate too. Okay, they actually get it by the average daily balance, and what you're supposed to do is like divide by 365 and then multiply the number of days, but we're not going to make it that complicated. Okay, so now the next month, right, the next month is going to be the last month's balance plus, plus the interest minus our cash flow, which is 1,600. 1,600. Okay, so take a look at this. Just by making our credit card as a line of credit, magically this 420 expense went to zero. So it's like we magically increased our cash flow doing nothing, right? 1180 to 1,600. Okay, so now what we do is, from going forward, you just copy and paste. You just copy and paste the formula, okay? And then now we just copy and paste, and let's do this, okay? So whenever it's negative, that means that, you just replace it with the zero manually. And let's see how long it took us. 2, 3, 4, 5, 6, 7, 8, 9. And so it took us about 9 months to pay off the debt, right? And how much did we, if we sum this up, okay, how much do we pay in about interest, estimated interest, about 1,200. It only took us 9 months to pay off $12,000 of debt, right? And now, after every month, we're actually going to have something in our checking and savings. We're not going to be in the situation the bank wants us to be. So after our first month, it's going to be 1,600, and then second month we're going to have 3,200, right? Amazing, amazing. And then after the third month, 4,800. So we're going to have actual real money in our checking and savings that hopefully we'll use to grow even further, like our investments or stocks, bonds. If you do that, I don't do that. I do real estate. So maybe this could be like a down payment for a home. But again, you'll have real money here, right? We'll have real money in our checking and savings, rather than this fake scenario where we have 12 grand in here and then we're paying interest to the bank, and that's where the banks want us, right? Because if we take a look here, if we just pay the minimum payment, which is essentially scenario one, we will pay 29 grand in interest. And look at this, we paid it off in about 9 months, and we only paid 1,200. Isn't that insane? Like, if you actually tally up what you're paying in interest, 29 grand, right? 29 grand to borrow 12 grand, or would you rather pay $1,200 to borrow 12 grand, right? This is why the banks have the biggest buildings in every downtown because they know what they're doing, and they study consumer habits to the T. Right? Like I don't know if you ever heard Dave Ramsey, but he goes on these rants that are really powerful about how banks know what you're going to buy before you even know what you're going to buy because they study your behavior based on what you purchase. All right. Okay. So this is Korean Atlanta mentorship. This is going to be the simplest velocity banking scenario where you just have one credit card as your debt, right? Normally we go over like 3 to 6 to 7, maybe as many as 15 debts. And then we dump our entire paycheck into a line of credit, take our expenses, and then we just wait for this to go to zero. And then now we're debt free in 9 months. Yes, we did rack up $12,000 of debt in 1 month for Christmas in 2023 because we YOLO'd, but it's okay. With a little bit of perseverance, we can get rid of that debt within a year. All right. So, one other thing, if you're interested in joining our group, go ahead and click the Google form link below, and then we'll get on a Zoom call to see if you're a good fit for the group. And then hopefully we'll start learning, if you join, learning about financial and real estate investing, literacy, and education. Okay, awesome. Well, have a great day, everybody, and we will speak next time.